All right, today we are diving deep into Restaurant Brands International. You probably know them as QSR. This is the massive company behind some of the most famous names in fast food. We're talking Burger King, Popeyes, Tim Hortons, you name it.
So, the big question we're all asking is this company, with all its famous brands, actually a smart place to put your money right now? Well, that's exactly what we're going to find out. Let's get into it.
Okay, first things first. To really get a handle on QSR as an investment, you've got to look past the Whoppers and the fried chicken. We need to understand the engine under the hood, how this company actually makes its money. So here they are, the heavy hitters in their portfolio: Burger King, Tim Hortons, Popeyes, and Firehouse subs. I mean, these are iconic brands, right? But the real story for us as investors isn't just the food, it's how QSR turns these famous names into cold, hard profit. And this is the secret sauce right here. Their whole strategy is built on what's called an asset-light franchise model. Think about it. QSR doesn't actually have to build and run most of the restaurants. That's on the franchisees. They're the ones putting up the cash for the buildings and the staff. What does QSR do? They just sit back and collect a steady stream of high-margin royalties and fees. It's an incredibly smart cash-generating machine. All right, so a smart business model is one thing, but how does it actually look on paper? How does it translate to the bottom line? Well, when we start looking at the financial health of the company, things get complicated. We're going to see some really impressive strengths, but also some pretty serious weaknesses. And this really lays out the two sides of the coin for any investor looking at QSR. On the one hand, you've got the good stuff: globally recognized brands, fantastic operating margins hitting around 26%, and a really strong, stable flow of cash coming in. But, and this is a big but, on the other side of the scale, you've got this massive pile of debt. And on top of that, super volatile earnings. I mean, they were down 56% year over year when this analysis was done. That's not great. So let's just put that debt into perspective for a second. This number here is a really big deal. Their total debt is more than 5.5 times their annual earnings, or what the finance pros call EBITDA. That is a heavy backpack to be carrying around. It's a major risk baked right into the structure of the business. Okay, so we've got this mix of good and bad, right? So what's the bottom line? What is this company's stock really worth? Not what the price is on any given Tuesday, but what's its true underlying value. Well, to get to that number, the analysis uses a pretty standard tool called a discounted cash flow model. It sounds complicated, but the idea is simple. You basically try to predict all the cash the company is going to make in the future, and then you calculate what all that future cash is worth in today's dollars. That gives you the intrinsic value. And drumroll please, the number the analysis comes up with is right around $60 a share. So based on its fundamental ability to pump out cash over the years, this business is worth about $60. Okay, $60. Got it. But here's the kicker. How does that number stack up against what people were actually paying for the stock out in the wild? This, my friends, is where the plot thickens. The market price at the time was almost $79. Let that sink in. The analysis says it's worth $60, but the market was paying nearly $80. That's a huge gap. It tells you the market was way more optimistic, maybe even a little euphoric, compared to what the cold, hard numbers were saying. So when you see a gap like that, the next logical question is, okay, so at what price does it become a good investment? Let's check out the specific price targets and different scenarios the analysts put together to find a smart entry point. Now, this table is super helpful. It flips the question around. Instead of asking, what's the return, it asks, what price do I need to pay to get the return I want? So if you want a solid 9% return each year, you can't just buy at the $60 value. Nope. You need what investors call a margin of safety. You need to buy it at a discount, which in this case would be around $52 a share. And it gets even more interesting when you factor in time. I love this part. Look how the price you can pay changes depending on how long you plan to hold the stock. If you're only in it for 5 years, you could technically pay up to $65 to get that 9% return. But if you're a long-term 16-year investor, you need a much better price, down at $52 to make the math work. Of course, the future is never certain, so the analysis lays out 3 different possibilities. You've got the bear case. This is the pessimistic view where things don't go so well, valuing the stock at $45. Then there's the base case, our most likely scenario, which lines up with that $60 intrinsic value we talked about. And finally, the bull case, the everything goes right, blue sky scenario, which puts the value up around $80, pretty close to where the market had it priced. So we've looked at the business model, the financials,
what it's worth, and what could happen in the future. After weighing all of that, what's the final verdict? Is this a buy, a hold, or a run for the hills situation? These scores pretty much sum up the whole story. The risk score, a 6.4 out of 10, so moderate. And that's almost all coming from that huge pile of debt we saw. The opportunity score, a 6.8 out of 10, again, moderate. So what does that tell you? There's potential here, for sure, but it is not a no-brainer screaming buy.
And here it is, the final recommendation laid out in black and white. The verdict is crystal clear. It's a good business, no doubt, but the stock is just too expensive right now. So the advice is either to hold it if you already own it or avoid it completely. The only time you should even think about buying is if the price drops below $52.
So let's wrap this up. What's the big takeaway? This is a textbook example of a great company that is not a great investment, at least not at its current price. The business itself, with its franchise model, is high quality, but the price you pay for an investment is everything. And right now, the price is just too high to give you that margin of safety you need. And there you have it, our complete breakdown of Restaurant Brands International. It's a really fascinating case study, isn't it? A great business, but maybe not a great stock for now. But hey, now I want to hear from you. What company should we tear down next? Let me know in the comments below.